What happens to your buying power when mortgage rates increase? Stay tuned. Well, the Fed came out with the announcement yesterday that we all knew was coming. Rates are going to go up in 2022. Now, it is important to understand that the Fed does not directly set mortgage rates, but it does create policies that do affect them indirectly. When the Fed increases the federal fund rates, the banks in turn pass on higher costs to their customers. Interest rates on consumer borrowing then tend to go up, and as short-term rates increase, long-term rates typically follow suit. Inflation hit 7% in January, and the Fed tightening monetary policies are all driving interest rates up. Federal Reserve officials have indicated that they expect rates to go up about 3 times in 2022. Those times are around March, June, and September. The National Association of Realtors reported that in the first week of 2021, the average rate on a 30-year fixed mortgage was at 2.65%. Contrast that with the first week of 2022, and the average rate on a 30-year fixed mortgage was at 3.22%. That's nearly 60 basis points higher than just a year ago. So how do these rates affect you and your buying power? Well, I reached out to Dan Davis, a preferred lender we work with out of Finance of America Mortgage. He provided me with some great information that I'm going to share with you that helps illustrate just how buying power works. So when you're ready to put in the offer on that perfect home, your buying power is directly related to how much you can afford. So if you need that monthly payment around $1,800 a month, then what Dan Davis provided me with perfectly illustrates your buying power. This is based off of a monthly payment of $1,796 at a 3.5% interest rate on a $400,000 loan. If that interest rate goes up to just 3.875%, you're now looking at a home at around $382,000. You just lost $18,000 in buying power. And if that interest rate goes up to 4.25%, which they're anticipating happening this year, you're now looking at homes at $365,000 and an almost $35,000 loss in buying power. So this perfectly illustrates that as interest rates start to rise, your buying power goes down. Whereas maybe at the beginning of 2022, you're looking at $400,000 homes. At the end of the year, you're looking at $365,000 homes. And the condition of those houses in that $365,000 range may start to deteriorate from what you expected at the $400,000 range. But you can apply it across the board on any price range, higher or lower. So as a home buyer, you should definitely first meet up with a lender so you can figure out how much you can afford, get pre-qualified, and they can better explain to you how rising interest rates could affect your buying power. Feel free to reach out to Dan for more information, and he can even provide you with a cost of waiting analysis. I know Dan would be more than happy to answer any questions you may have. So what will happen in the first part of 2022? Well, nobody really knows for sure, but we can expect that buyers will want to get out into the market and try to lock in these lower rates before they do rise. They want to take advantage of that buying power. Also, with a lower inventory in the Puget Sound area, we can expect multiple offer situations, which means that you're going to still have to come to the table with a strong offer to get that home that you really want. Well, I hope this helped you understand just a little bit better about how interest rates can affect your buying power when looking for your new home. If you have any questions, please feel free to reach out to us. We're more than happy to help. Also, make sure to like and share these videos on our Facebook and Instagram pages. And check out our YouTube channel and like and subscribe there. Also hit the bell notification so you're notified every time we put out a new video. Thanks a lot, you guys. Have a great week, and I'll see you next week.